Good afternoon, ladies and gentlemen. Welcome to the weekly wrap-up for May 20th, 2022. Hope everybody's having a great day out there. It is snowing here in beautiful Colorado. We probably have, I don't know, 2 or 3 inches building up on the rocks outside my office. And based on the forecast, we could get anywhere from 12 to 18 inches. So not exactly spring weather by any stretch of the imagination. So I hope most people out there are enjoying a nice day. I realize most of y'all are down in Texas, and it's probably hot and sweaty right now. So you're welcome to come up here if you can get here and help me shovel some snow. Actually, I probably won't be doing any shoveling. It'll probably just melt away over the next couple of days pretty easily. So, all right, kind of a strange day in the markets. It was down most of the day and had a nice little rally at the end to finish, well, barely in the positive for most of the indexes. So let's go ahead and jump in and take a look and see how we did today. Dow Jones finished flat at down 0.03 at 31,261. SP 500 was flat, down 0.01 at 3901. NASDAQ finished down 0.3% at 11,354. Small caps are down 0.44%. The VIX climbed up today 0.27%. It's at 2943 as of right now. It was over 30 most of the day because I know it kept crossing back and forth across the across that 30 line, and my alerts on my my screen kept dinging every time it went back and forth. All right, moving on down to the other exchanges here in the Americas. Canada was flat at up 0.08. Brazil was up 1.39. Mexico up 0.45. Heading over to Western Europe, Germany up 0.72, UK up 1.19, France up 0.2, Euro stocks up 0.45, Netherlands up 0.68, Spain up 0.93, Italy up 0.12. The first down in Europe I see is Switzerland down 0.19, Portugal up 0.28, Belgium up 0.78, Austria up 0.41. Sweden was up, or basically flat at 0.08. Denmark up 2.79. Both the Russian exchanges were down. The MOEX was down 2.6. The RTSI down 4.47. Poland was down, eyes are getting crossed today. Poland was up 0.35. Hungary up 0.74. Turkey down 0.89, Israel down 2.26, as well as Saudi Arabia down 2.25. Heading over to the Asian markets, I see almost nothing but green. Japan was up 1.27, Australia up 1.15, the New Zealand up 0.84. Moving down to China, the Shanghai was up 1.6, the SESE component up 1.82, China A50 up 2.47. DJ Shanghai up 1.76. The Hang Seng was up, 2.96. And the Taiwan weighted up 0.78. And then mostly, or all greens except for one red in Vietnam, it was down 0.08. So the trading day started out really good. It was nothing but greens across Asia, except for that one in Vietnam, which was pretty much flat. And then we started to wane a little bit in the Middle East area. They were down, a little bit, and but Western Europe looked good. And then, like I said, we finished the day flat, even after a lot of back and forth. So let's go ahead and take a peek at how the indexes did for the week. The Dow Jones looks like it's going to finish up down 2.78 for the week. The SP 500 finished down 2.92. NASDAQ finished the week off down 3.77. Dow Utilities, where's the line? It's going to finish down 0.62. And the Dow Transports finished down, 6.86%. So a pretty ugly day. You've probably been seeing a lot of news that we're headed into bear market territory. So just to give you a look and see where we stand right now, as far as the Dow Jones, For the year to date, it's down 14.6, so it's still in correction territory. You have to get below 20% down to actually hit a bear market. The S&P 500, let's take a look here. It's down approximately 18% right now, so it's getting really, really close. I think it actually dipped into bear territory earlier today, just during the intraday, but finished above. And the NASDAQ right now is about 28% down. So it's already in bear territory at this moment. So if you're heavily invested in technology stocks or just the NASDAQ in general, you're probably getting beat up. You're probably down by a third right now, or almost by a third year to date. So pretty rough out there. All right. So let's take a look at the economic data that came out this week and see what the good news is there. All right. As far as U.S. Initial jobless claims, they came in at 218,000. I know I covered that in an article in the most recent days. The forecast came in at 218,000 against a forecast of 200,000. So a little bit higher than we'd like above the forecast, but again, nothing horrible yet. I know a lot of the talking heads out there have been saying that the job market's slowing down and cooling, but we'll see. Continuing jobless claims came in at 1.317 million against a forecast of 1.32. So again, still heading in a good direction, which is really, really nice to see. The index of leading economic indicators came in at a negative 0.03. The forecast was supposed to be a positive 0.3. So not great, but is what it is. Retail sales year over year this month came in at an 8.19% number. The previous was 7.34. So you can see we did have a bit of a drop off from the March numbers into April, and a little bit of a bounce back for the numbers for this month. Industrial production year over year came in at a 6.4 number. Last month's number was a 5.47. So again, it did go back up a little bit from last month's number. Housing starts came in at 1.724 million. The forecast was 1.765 million. So about 40,000 under forecast. Not terrible. Again, looking back historically over the last couple of years, we did have that big drop off, obviously, with the what happened with COVID, and then it's been pretty stable here of late. So we'll see if we see a major downtrend there. Existing home sales came in at 5.61 million. Forecast was 5.65. Again, off by about 40,000. But you can see here on the chart, if my cursor will get out of the way, that the last few months it's been it was sort of a slide down. So we've gone from existing home sales above 6 million for from October through February and March, and the last 2 months have come in at a number below 6 million. So could be just that the inventory is drying up and there's not a lot to buy out there. The Baker Hughes rig count right now, we're sitting at 576 rigs online. Last week's number was 563. So it has jumped up 13 rigs in the last week. And again, looking at the longer term chart, you can see we're still below that, close to 600 number we were at prior to all the craziness of 2 years ago. So, I'd like to see us get, more rigs online, but again, I'm not the guy who makes that decision. I know the more oil, if we have a glut of oil, then prices will come back down. As long as there's still, supply constraints, it's going to be, some tough sledding for a little bit. So, all right. So that's all the economic data that we had on the docket for this week. Let's go ahead and jump into today's market recap. SP 500 enters bear market as intraday rebound runs out of steam. The SP 500 dropped into bear market territory on Friday, intraday. This was obviously written prior to the close. After an earlier rebound ran out of steam and ongoing worries about inflation led inflation-led dent to growth offset fresh support from China to support its economy. Consumer discretionary led the sea of red on Wall Street after quarterly results from corporates continue to flag the impact of inflation, just as the Federal Reserve shows little sign of slowing down rate hikes. St. Louis Fed President James Bullard said Friday that raising rates by 50 basis points at upcoming meetings was a good plan and stressed that higher interest rates would be needed to keep inflation under control. Ross Stores plunged 23% after first quarter results fell short of Wall Street estimates, and the off-price retailer cut its guidance amid pressure from higher transportation and labor costs. Weaker results come as the other retailers, including Walmart and Target, reported results earlier in the week, also stoked worries about the impact of inflation. Deere, meanwhile, the tractor company, reported quarterly results that missed the top line and highlighted the impact of inflation and supply chain issues ahead, sending its shares more than 14% lower. Foot Locker Inc. bucked the trend, rising more than 3% after the footwear retailer reported better than expected profit that helped overshadow some softer revenue and same-store sales. The ongoing worries about inflation offset early day optimism after China's move to cut a key lending benchmark to support its economy, which had been impacted by recent lockdown measures in Shanghai and elsewhere, eased fears about slowing global growth. Quote, investors appear more optimistic this morning after a volatile week as China takes its latest step to bolster the country's economy, end quote, Stifel said in a note earlier on Friday. Technology gave up early day gains to add fuel to the sell-off, while with Apple and Google leading the sell-off in big tech. The broader market's foray into bear market territory has some speculating whether a bottom will soon be reached, but experts suggest there's still more pain ahead as investors' capitulation has reached the levels of prior market downturns. Quote, we have been encouraged by the breadth and manic selling activity occurred a few days throughout the recent correction cycle. However, we are not yet seeing comparable capitulation metrics relative to the 2018 or 2020 market downturns, Janie Montgomery Scott said in a note. Quote, this suggests to us that we are not, that even though we are in or close to a bottom range, we may have to experience more volatility before the markets are more thoroughly washed out ahead. See, that's where I disagree. I looking back historically, and let me bring up a chart here, make it bigger so you can see it. If we go back and look at, previous downturns, again, the most recent one was in March of 2020. Things receded about 35, 36%. Going back to the downturn of 2008 and 9, markets were down about 49%. The dot-com bust it was kind of a slow bust, but the downturn in 02 and 03, we were lost about 22%. And it's as far back as my chart will go. So, like we just talked about with the, or like I showed you earlier, as far as how far we've receded from the first of the year, which was the peak, I just don't see that we're close there yet. But again, I could be completely off base. Who knows? All righty. Let's see what we got here. Hey, thanks, Tim, for the thumbs up. Appreciate it. All right. The article I mentioned yesterday that I was going to go through, it's a bit long, so I only have one other article after this, but it's titled Federal Reserve Policies Aimed at Creating Price Stability Bring About Economic Instability. And this was written by Frank Shostak. Who is Frank? Frank is has a consulting firm, Applied Austrian School Economics, provides in-depth assessments of financial markets. And if it's on Mises Wire, it's usually pretty good. All right, let's go ahead and dive into this. For most economists and politicians, the role of central bank authorities is to make the economy as stable as possible. What do they mean by economic stability? Economic stability refers to an absence of excess fluctuation, so an economy with constant output growth and low and stable price inflation is likely to be regarded as stable. An economy with frequent boom-bust cycles and variable price inflation would be considered unstable. According to popular thinking, a stable economic environment in terms of stable price inflation and stable output growth acts as a buffer against various shocks. This makes it much easier for businesses to plan. In this way of thinking, in particular, price level stability is the key for economic stability. For instance, a relative strengthening in people's demand for potatoes versus tomatoes may take place. This relative strengthening is going to be depicted by the relative increase in the price of potatoes versus tomatoes. To be successful, businesses must pay attention to consumers' wishes as manifested by changes in the relative price of goods and services. Failing to abide by consumers' wishes will lead to the wrong production mix of goods and services and will lead to losses. Hence, in our case, by paying attention to relative changes in prices, businesses are likely to increase and the production of potatoes versus tomatoes. If the price level is not stable, then the visibility of the relative price changes become blurred, and consequently, businesses cannot ascertain the relative changes in the demand for goods and services and make correct production decisions. This leads to a misallocation of resources and to the weakening of economic fundamentals. Unstable changes in the price level obscures changes in the relative price of goods and services. Consequently, businesses will find it difficult to recognize a change in relative prices when the price level is unstable. Based upon this way of thinking, it is not surprising that the mandate of the central bank is to pursue policies that will bring a stable price level. Using various quantitative methods, the Fed's economists have established that they must aim at keeping price inflation at 2%. Any significant deviation from this figure constitutes deviation from the growth path of price stability, which is an admission that the Fed policymakers believe they have to stabilize the price level in order to allow the efficient functioning of the market economy. Obviously, this is a contradiction in terms, since any attempt to manipulate the so-called price level implies interference with markets and hence leads to false signals as conveyed by changes in relative prices. By means of setting targets of interest rates and by means of monetary pumping, it is not possible to strengthen economic fundamentals, but on the contrary, only makes things worse, and here's why. A policy of price stability leads to more instability. Assume that the so-called price level begins to show a decline in growth momentum. To prevent this decline, the Fed aggressively pushes money into the banking system. Because of this, following a time lag, the price level stabilizes. Should we regard this as a successful monetary policy action? I don't know. Given the monetary pumping sets in motion the diversion of wealth from wealth-generating activities to non-wealth-generating activities, this leads to the weakening of the wealth generation process and to economic impoverishment. Note that the economic impoverishment has taken place despite price level stability. In order to achieve price stability, the Fed has had to allow an increase in the growth momentum of the money supply. The fluctuations in the growth momentum of money supply matter here because they set in motion the menace of the boom and bust cycle, regardless of whether or not price level is stable. While increases in money supply are likely revealed in general price increases, this is not always the case. Prices are determined by real and monetary factors. Consequently, if real factors are pulling things in opposite directions to monetary factors, no visible change in prices might take place. Even if money growth is high, consumer prices might display only moderate increases. Clearly, if we were to pay attention to so-called price level and disregard increases in money supply, we would reach misleading conclusions regarding the state of the economy. Murray Rothbard wrote, "The fact that general prices were more or less stable during the 1920s told most economists that there was no inflationary threat, and therefore the events of the Great Depression caught them completely unaware." All right, next section. The assumed neutrality of money is the root of price stabilization policies. The view that money is neutral and is at the root of price stabilization policies. Changes in money only affects the price level while having no effect upon the real economy. This way of thinking holds that changes in money supply do not affect relative price of goods and services. Well, that's not true. For example, if one apple exchanges for 2 potatoes, then the price of an apple is 2 potatoes. Or the price of a potato is half an apple. If one apple exchanges for $1, then it follows that the price of a potato is 50 cents. Now, that the introduction of money does not alter the fact that the relative price of potatoes versus apples is 2 to 1. Thus, a seller of an apple will receive $1, which then enables him to purchase 2 potatoes. In this way of thinking, an increase in the quantity of money leads to the proportionate fall in purchasing power, or a proportionate rise in the price level, while a fall in quantity of money results in a proportionate increase in purchasing power of money, or a proportionate decline in the price level. That is, one apple exchanged for two potatoes, all other things being equal. Let us assume that the amount of money has doubled, and as a result, with the purchasing power of money being halved, doubling the price level. This means that one apple now can be exchanged for $2, while one potato for $1. Note that despite the doubling of prices, a seller of an apple with the obtained $2 can still purchase two potatoes. We have a total separation between changes in relative price of goods, how many apples exchanged per potato, and the changes in the price level. Therefore, it would appear that the only problem with inflation is that it obscures the visibility in the movements of the relative price of goods, thereby causing a misallocation of resources. Other than that, inflation is harmless. What's the problem with this way of thinking? Following the Cotillon effect, when new money is injected, there's always the first recipients of the new money that benefit. The first recipients with more money at their disposal can now acquire a greater amount of goods while the prices of these goods are still unchanged. As the money starts to move through the economy, prices of goods begin to rise. Consequently, the late receivers of the new money benefit less, or may even find that most prices have risen so much that they can now afford fewer goods. Increases in the money supply lead to a redistribution of wealth from later recipients or non-recipients of new money to the earlier recipients. We suggest that this shift in wealth alters the individual demand for goods and services, and in turn will alter relative prices of goods and services. Changes in money supply sets in motion new dynamics that give rise to changes in demands for goods and changes to their relative prices. Hence, changes in money supply cannot be neutral as far as relative prices of goods are concerned. Price levels cannot be ascertained conceptually. It is not possible to establish the total purchasing power of money and hence the price level. When $1 is exchanged for one loaf of bread, we can say that the purchasing power of $1 is one loaf of bread. If $1 is exchanged for two tomatoes, then also means that the purchasing power of $1 is two tomatoes. This information regarding the specific purchasing power of money does not, however, allow the establishment of the total purchasing power of money. It is not possible to ascertain the total purchasing power of money because we cannot add up two tomatoes to one loaf of bread. We can only establish the purchasing power of money with respect to a particular good in a transaction at a given point in time and at a given place. Now the Fed's monetary policy that aims to stabilize the price level by implication affects the growth rate of the money supply. Since changes in the monetary supply are not neutral, this means that the central bank policy amounts to tampering with relative prices, which leads to disruption of the efficient allocation of resources. As a result, the policy of stabilizing prices leads to the overproduction of some goods and the underproduction of some other goods. This is not what stabilizers are telling us, however. Instead, they believe that the greatest merit of stabilizing prices in the price level is that it allows free and transparent fluctuations in the relative prices, which in turn leads to the efficient allocation of scarce resources. What matters for economic prosperity is not price stability, but rather allowing free relative price fluctuations. Free fluctuations in prices only can take place in an environment free of government and central bank tampering with the economy. This in turn allows businesses to abide by the wishes of the consumers, which permits an efficient allocation of scarce resources. We believe central authorities do not tamper with markets. Fluctuations in prices will mirror changes in the relative supply-demand conditions. Note that the Soviet Union, after 1947, established a stable price framework based on fixed prices. While this prevented price inflation, they created persistent shortages of food and consumer goods. By not allowing the free movement of prices, this resulted in drastic decline in individual living standards. Summary and conclusion. Most economists believe that the key to a healthy economic fundamentals is price stability. A stable price level, it is held, leads to the efficient use of the economy's scarce resources and hence results in better economic fundamentals. It is not surprising then that the mandate of the Federal Reserve to pursue policies that generate price stability. By employing monetary policies that aim to aim at stabilizing the price level, the Fed actually undermines the market economy. Although the former Soviet Union had low inflation in terms of prices of goods because the price mechanism was kept stable by government decree, the side effects of this policy included persistent shortages and low living standards. Thus, it appears that the ever-growing interference of the government and central bank with the workings of market drives the U.S. economy towards persistent economic impoverishment and drastically lower living standards over time. Yeah, that was a lot, I know. So if you want, it is attached in the show notes, so you can read that at your own leisure. But again, it is the belief of a lot of folks that the Fed's doing more harm than good. And unfortunately, we're just the victims of it. All right. Last article I got here. The odds of a home price correction just spiked. This interactive chart shows your local housing market is at risk. There's no way around it. The Federal Reserve is going to get runaway inflation back under control. It's going to cause some economic damage along the way. The central bank has already put immense downward pressure on mortgage rates, which have spiked from 3.11 to 5.25 over the past 5 months. As it works to cool one of inflation's biggest drivers, the booming U.S. housing market. Excuse me. If policymakers can slow down housing, they have a shot at slowing down overall price growth. Quote, stock prices were very high relative to pre-pandemic. Home prices are at very high relative to pre-pandemic. My theory is that all of this is leading people to feel more confident and to spend more, and maybe what's pushing us into higher consumption, higher spending, and higher inflation, said Neil Kashkari, president of the Federal Reserve Bank of Minneapolis. Does that mean that the Fed will cause home prices to have their own correction? Who knows? We were already seeing the U.S. housing market slow down in the face of spiking mortgage rates. Mortgage applications are declining, fewer listings are getting multiple offers, and inventory levels are rising again. However, that's a deceleration, meaning prices are going up at a more modest rate, not a price correction. Last month, Fortune, the magazine, reached out to real estate research firm CoreLogic to see if it would provide its assessment of the nation's largest regional housing markets. CoreLogic looked at 392 U.S. housing markets, U.S. markets in April, and found that 17 regional markets had greater than 40% chance of seeing local home prices decline over the next 12 months. The U.S. macroeconomic situation has soured since April. To see if that downturn has shifted the outlook of the housing market too, Fortune once again asked CoreLogic to run an assessment of regional housing markets. The finding: now 70 regional housing markets have a greater than 40% chance of home prices dropping in the last 12 months. What was the previous? 17. So it's gone from 17 to 70. That's a pretty big jump just in a short period of time. But before we dive deeper into the data, let's look at how CoreLogic did the analysis. In order to determine the likelihood of regional home prices dropping, the real estate research firm assessed factors like income growth projections, unemployment forecasts, consumer confidence, debt-to-income ratios, affordability, mortgage rates, and inventory levels. Then CoreLogic, which ranked CoreLogic, which is ranked 952 on the Fortune 1000, put regional housing markets into 5 categories, grouped by the likelihood that home prices in a particular market will fall over the coming 12 months. Here are the groupings used for May analysis. So very high, high, medium, low, and very low. And let's see if we can look at that chart. All right, so here's the chart. You see the very lows are blue, the reds are the very highs. So just a quick glance at this, you see like the Prescott, Lake Havasu area is really, really high. Bend, Oregon. What are some of the high ones here? Kind of a peach color. Boise, Idaho. Eugene. It's another red one here. That Bridgeport, Connecticut is red. But most of the U.S., from Florida across the Sun Belt up into the Midwest, mostly blues. So that is some good news. All right. Among the 392 regional housing markets that CoreLogic measured, 144 ranked in the very low group. Another 177 housing markets landed in the low group, 44 markets in the medium, and 22 crept into the high group. CoreLogic categorized only 4 markets as having very high likelihood of a price drop: Bend, Oregon; Prescott, Arizona; Bridgeport, Connecticut; and Bridgeport, Connecticut. I just said that looking at the map. When CoreLogic analyzed the housing market back in April, the company found that the average market had a 13% chance of experiencing a home price drop over the coming 12 months. Now, CoreLogic says the average regional housing market has a 28% chance of a price drop over the coming 12 months. That's a 15% price point spike in just a 1 month period. Why the big spike over the past month? CoreLogic points to surging mortgage rates, declining consumer confidence, and home price overvaluation. While CoreLogic finds the odds of home price correction are rising, it still believes nationwide home prices will inch higher over the coming year between March 2022 and March of 2023. CoreLogic predicts U.S. home prices will rise another 5.9%. So as of right now, they're just seeing mostly a slowdown in home prices based on their analysis. So, just a few minor areas maybe where things are overbought. You could see a retraction in prices, but again, be careful. It's going to be a bumpy ride out there over the next couple of months. So just make sure you're staying ahead of things, staying educated, staying on top of what's going on in the world, and you should be all right. So hopefully. All right. Well, hope everyone has a fantastic weekend. I'll be back Monday with the weekly updates. The snow is still coming down outside, so hopefully my trees don't collapse, because that's the downside of having a big snowfall this late in the year, or early in the season, because it's usually wet and heavy, and the trees still have all their leaves on them. Or now the leaves have come back in the recent weeks, and the scrub oaks out here in front of my house are bent over sideways. So let's hope none of the big trees fall on my house and crush me. That would be bad. All right. Well, again, hope everyone has a fantastic weekend, and I'll see you guys then. Bye.